You bought the dip. You told yourself you did your research. You watched a few YouTube videos, read a couple of headlines about ChatGPT and Nvidia, maybe even joined a Reddit thread where everyone was talking about how AI is the next internet. And then you opened your brokerage account, hit buy, and felt like a genius. For about 3 weeks, then the stock dropped 34%, and suddenly your long-term investment became a painful lesson you're not sure you've fully learned yet. If that story sounds uncomfortably familiar, stay with me, because what I'm about to tell you could save you from making the exact same mistake again, just with a bigger account balance this time. My name is Vicky, and I spend way too much time thinking about how smart people make financially stupid decisions. If you're someone who wants to build real wealth but keeps second-guessing whether you're investing in the right things at the right time, hit subscribe and give this video a thumbs up. We're going deep today. Here's the thing. I'm not here to tell you AI is a scam. I'm not a doomer. I'm not going to sit here and pretend that artificial intelligence isn't one of the most consequential technological shifts in human history. It absolutely is. But there's a massive, almost criminal difference between a world-changing technology and a world-changing investment. And most people, even people who consider themselves financially savvy, have absolutely no idea where that line is. And that confusion is costing them real money. Let me take you back to something. The year was 1999. The internet was going to change everything. And guess what? It did. Companies were going public every other week. Pets.com raised $82.5 million in its IPO. Webvan, an online grocery delivery company, was valued at $1.2 billion before it ever turned a profit. Investors poured money in because the technology was real, the future was real, and the FOMO was absolutely suffocating. Then the Nasdaq crashed 78% between 2000 and 2002. 78%. And here's the painful irony. The internet did change the world. Amazon exists. Google exists. But most of the people who invested in the internet in 1999 lost fortunes on companies that no longer exist. The technology won. The investors lost. Now look, I need you to sit with that for a second, because the psychological trap isn't stupidity. It's a very natural, very human cognitive bias called narrative bias. Our brains are wired to latch onto compelling stories. And AI is going to change everything is one of the most compelling stories told in a generation. When you hear it, your brain doesn't just process information. It starts building an emotional case for why you need to be part of it. It triggers the same neural pathways as social belonging. Missing out on AI stocks doesn't just feel like a financial mistake. It literally feels like being left behind by civilization. And that feeling, that is the single most dangerous fuel for bad investment decisions. Here's what most people don't realize. The stock market doesn't price in what's going to happen. It prices in what people expect to happen. And right now, the expectations baked into AI stocks are extraordinary. We're not just talking about companies being priced for growth. We're talking about companies being priced for near-perfect execution across a decade-long horizon in a space that is changing so rapidly that even the people building the technology can't tell you exactly where it lands. According to Goldman Sachs research, the AI sector has seen valuation multiples that, in some cases, price in revenue growth of 40 to 50% annually for the next 7 to 10 years. Let that settle in. Any disappointment, any earnings miss, any regulatory speed bump, any competitor breakthrough, and the repricing can be brutal and fast. This is where it gets interesting. Let me show you the math, because I think most people are investing in AI without actually doing the math. Let's say you invest $10,000 in a high-flying AI stock trading at 80 times forward earnings. That's not unusual right now. Some of the most popular AI names are trading at 60, 80, even 100 times projected earnings. For that investment to double in 5 years, just double, not make you rich, just double, the company needs to grow into its valuation while also expanding. If earnings don't grow fast enough to justify the multiple, the stock can actually go sideways or down even while the company is technically succeeding. This is the trap. You can be completely right about the technology and completely wrong about the stock. Being right about AI doesn't automatically mean your portfolio is going to benefit from AI. Now, you might be thinking, okay, Vicky, but what about Nvidia? Nvidia went up like 200% in a year. And yes, you're right. Nvidia has been one of the greatest stock stories of this decade. But here's the thing about Nvidia. Most of the people I talk to who are citing Nvidia as their reason to buy AI stocks right now didn't buy Nvidia when it was cheap. They watched it go up, felt the FOMO, and are now either chasing Nvidia at peak valuation or using it as emotional permission to buy other AI stocks that don't have anything close to Nvidia's actual competitive moat. That's not investing. That's retroactive justification. You're using someone else's winning trade to emotionally validate a very different trade you haven't fully analyzed. Here's a metaphor that I think captures this perfectly. Imagine a gold rush. There's gold in those hills. Everyone knows it. It's real. The gold is actually there. Now you have two types of people. The first type runs into the hills, starts digging, and spends everything they have on land, claims that may or may not have gold. The second type looks around, notices that every single person running into the hills needs pickaxes, jeans, food, and supplies, and starts selling those instead. In the California gold rush of 1849, most miners died broke. Levi Strauss, who sold durable pants to miners, built a company that still exists today. In the AI boom, Nvidia is Levi Strauss. They're selling the pickaxes, the GPS, and the infrastructure that every AI company on the planet needs to function. That's a fundamentally different investment than buying companies that are still trying to find the gold. And this brings me to a framework I want you to genuinely internalize before you buy a single AI-related stock. I call it the layer test. You need to identify which layer of the AI economy a company actually operates in. Layer 1 is infrastructure, semiconductors, data centers, cloud computing, and the physical backbone of AI. These companies benefit regardless of which AI application wins. Layer 2 is the platform layer. Companies building the foundational models and APIs, the large language models that others build on top of. Layer 3 is the application layer, companies using AI to build products for end users. Here's the thing. The further up the layer stack you go, the more speculative the investment becomes. Layer 3 companies are making a bet not just on AI, but also on their specific product, winning in a market that is redefining itself every 6 months. The number of AI startups that will still exist in their current form in 5 years is genuinely unknowable. But the demand for the infrastructure powering all of them, that's considerably more predictable. Now look, none of this means you should never invest in AI. That would be like someone in 1995 telling you to avoid anything internet-related for the rest of your life. The opportunity is real. But the way most retail investors are approaching it is deeply flawed. According to a Dalbar study on investor behavior, the average retail investor consistently underperforms the broader market, not because of bad stock picks necessarily, but because of buying high and selling low, driven by emotion. In bull markets in exciting sectors, this pattern accelerates. People buy in during the hype, can't stomach the volatility when it comes, and sell right before the recovery. The technology wins. The impatient investor loses. Here's what the psychology research tells us, and I find this genuinely fascinating. A 2023 study from the National Bureau of Economic Research found that individual investors who traded most actively in high-excitement sectors with heavy media coverage, social media buzz, and cultural relevance, underperformed passive investors in the same sectors by an average of 3.7 percentage points annually. And 3.7% might not sound catastrophic, but compounded over 20 years on a $50,000 investment, that gap is the difference between $190,000 and $293,000. Nearly $100,000 lost, not to bad timing or bad luck, but to the natural human tendency to feel like you need to do something when you're excited about something. Excitement is the enemy of wealth building. Calm, boring, systematic discipline is the engine of it. This is where it gets practical because I don't want you leaving this video with fear and no direction. Here's what I'd actually do. If you genuinely believe in the long-term AI trajectory, and I think there are strong reasons to, then your first move is to stop trying to pick the AI winner and instead buy the entire trend through diversified exposure. Broad-based technology, ETFs, or specifically AI-focused ETFs that spread your risk across the infrastructure, platform, and application layers give you exposure to the upside without betting your financial future on one company's ability to outcompete an entire field of very well-funded competitors. You participate in the wave without needing to pick the exact right surfboard. Your second move is position sizing, and I cannot stress this enough. If you're putting more than 5 to 10% of your investable assets into any single high multiple, high growth, high speculation sector, you are not investing. You are gambling with conviction. The risk is asymmetric in the wrong direction. If you're right, you do great. If you're wrong, the damage to your overall portfolio is severe enough to set your timeline back years. Most people don't think about opportunity cost. The money tied up in a losing position is money that isn't compounding somewhere more reliable. That cost is invisible, but absolutely real. Your third move is to be honest with yourself about your actual time horizon. There's a version of this where AI stocks absolutely deliver extraordinary returns, but that version probably plays out over 10 to 15 years with significant volatility along the way. Drawdowns of 40, 50, even 60% in individual growth names during that window are entirely plausible and historically precedented. If you're not prepared, both financially and psychologically, to hold through that kind of pain without selling, then you should not be in individual AI stocks at the current valuations. Your behavior during the dip will determine your outcome more than your stock selection before it. And look, I want to be direct about something that most financial content doesn't say clearly enough. There is no shame in building wealth slowly. In fact, the people I know who have genuinely built life-changing wealth, not lottery ticket windfalls, but real, durable, multi-generational wealth, almost all did it with a combination of boring consistency and selective patience. They didn't chase every hot sector. They invested in things they understood, held for longer than felt comfortable, and let compounding do the heavy lifting that excitement never could. The $10,000 invested in a broad market index fund 20 years ago is worth approximately $67,000 today, without a single moment of stress about which AI company would win. Just steady, unremarkable growth that quietly changed someone's financial life. Here's the thing about this AI moment that I genuinely believe. The companies that benefit most from AI over the next decade probably aren't the ones on the front page of every financial news outlet right now. They're the companies quietly integrating AI into their operations, cutting costs, improving margins, and expanding capabilities in ways that don't generate headlines but absolutely generate earnings. The boring insurance company using AI to process claims faster. The logistics firm is using AI to optimize routes. The bank is using AI to detect fraud more efficiently. These are not the companies people are buying in FOMO, but they're often the ones where the financial math actually works. The AI hype is a distraction from the AI opportunity. So before you buy, and I mean this seriously, ask yourself 3 questions. 1. Do I understand this company's actual business model well enough to explain how it makes money without mentioning AI? 2. Can I articulate a specific reason this company will win in its space rather than just benefit from a general trend? And 3. Am I comfortable holding this position if it loses 40% of its value over the next 12 months while the long-term thesis is still intact? If you can't answer all 3 honestly, you are not ready to invest in this company. You're ready to gamble on it. And there's a difference. The AI revolution is real. The opportunity embedded in it is real. but the graveyard of investors who were right about a technology and wrong about their investments is also very real. Don't let the story seduce you faster than the math can anchor you. Take your time. Do the work. Think in decades, not headlines. And if nobody else is going to say it to you clearly, let it be me. The best investment you will make this year might have absolutely nothing to do with AI. It might be paying down high-interest debt that's costing you 24% annually. It might be maxing out a tax-advantaged retirement account. It might be building an emergency fund so that when the market does drop 40%, you have the financial stability to hold instead of panic selling. Those decisions don't make headlines. They don't get Reddit threads. But they are the foundation on which actual wealth is built. And without that foundation, no AI stock in the world is going to save you. Invest smart, think long, stay boring.